What's the advertisement if you're pitching value stocks now? What's the tagline in the commercial?
It's got to work someday.
That's all you got, right? Okay. What do you make of this? This is pretty remarkable to me.
It is remarkable. I mean, I think about it more in the context of how do stock markets work? And ultimately, stock markets value future cash flows, right? That's what we all know. And the question becomes, is it as easy to forecast future cash flows in all industries and in all styles? And the answer is no. It is much harder to do in growth. So there's this paper, we've talked about it before, but Henrik Bessenbinder, Long-Term Shareholder Returns, Evidence from 64,000 Stocks. Fantastic paper. And it shows that over the last 30 years, 1990 to 2020, only 2% of stocks, 2.4% of all U.S. equities created all the value in U.S. equities.
It's crazy.
1.4% of global equities created all the value in global equities. And what are the top 10 names?
Everyone knows them by now.
I will repeat them.
Yeah.
Apple, Microsoft, Amazon, Alphabet, Tencent, Tesla, Walmart, Facebook, Samsung, and Johnson & Johnson alone are worth 14% of all the shareholder wealth creation from 1990 to 2020.
That's wild.
Yeah.
Okay.
So all growth stocks, right? Why is that? Because it's really hard to forecast growth in tech or in very high quality systematically
managed growth. So they kept surprising
growth.
people?
Yes.
That's the answer.
That's the answer. So where do you get surprised? Like we had this question in business school all the time, being asked by interviews. In one word, what drives stock prices?
Upside or downside surprises?
Surprises?
Earnings.
Yeah, surprise was the only acceptable answer.
Not earnings.
No, surprise.
Because it could be an earnings surprise.
It could be a management surprise. It could be a
new
market
CEO.
share surprise.
Right.
But surprise. What is known, what is not known today that happens tomorrow drives stock prices. Where are there surprises in value stocks? Are we surprised at JP Morgan?
They're mostly negative.
Right. Or at the very least, they do what they're supposed to do. JP Morgan, great company, good stock.
You'll never be surprised.
Not a lot of surprise, but that's okay. So if you think about why does growth outperform value now versus like pre-2008, value had a great run. Value worked. But as things began to get more technologically advanced, as Moore's law kept turning and turning and turning, and innovation kept happening, it became very hard to forecast tech and very easy to forecast by relatively anything in value. That's my explanation.
Because the tech names were able to continue to innovate at such a high rate that every quarter there was a surprise.
Yes, and every 3 years you get a brand new product.
Brand new company in some cases.
Yeah,